Assalamualaikum and good day everyone. So today we are going to learn about the short-term financing. Okay, so in general, short-term financing is a loan with a maturity period of 1 year to 5 years. So when your business does not qualify for a line of credit from a bank, you might still have success in obtaining money in the form of one time, which is short-term loan. So if you have a good banking relationship with a banker, he or she might willing to provide a short-term note for you to build up your account receivable. So the main issue involved in managing short-term financing are how much short-term financing should be used by the firm and what type of firm should be considered for short-term financing. So throughout this topic, you will describe the mechanics of the different types of short-term borrowing and also evaluate their costs. And you will learn regarding cost of financing. Okay. So basically short-term financing is a loan, pinjaman, loan with a maturity period of 1 year to 5 years. The main issue I mentioned just now, how much short-term financing should be used by the firm and what type of firm should be considered for wrong spelling, short-term financing. So this is the basic factors to consider in setting source of short-term credit: effective cost credit, available credit and amount of time it's needed, and the influence of used credit resources to the cost and availability of other financing sources. Types of short-term credit. There are two types of short-term credit. First one is unsecured financing. Unsecured financing is the financing provided by bank without imposing other form of collateral, or we say it as cagaran. Bank simply require personal guarantee from the borrower. You don't have to provide any collateral, but you need a guarantor from the borrower. And the second one is secured financing. Secured financing where you need a debtor to provide security before they can obtain financing. So, as a precautionary measure, bank will charge a deposit against the loan made. For example, collateral in the form of account receivable. Cost of credit. Cost of credit is the short-term interest rate are lower than long-term interest rate due to the time value of money. So short-term interest rate fluctuate more frequently, where the procedure of short-term cost involve interest equal to principal time rate time period. Contoh, example, XYZ company want to borrow 2,000 for a period of 90 days at a rate of 12% per annum. So you want to count the interest. So interest will be 2,000 times 12% times how many days? 90 days over 360. Because you have to divide per annum. So divide by 360. So the answer is 60. The interest is 60. So the effective rate of interest is the interest rate on a loan or financial product restated from the nominal interest rate. Effective rate of interest. What is effective rate of interest? interest rate on a loan or financial product restated from nominal interest rate as interest rate with annual compound interest payable in arrears. So it is used to compare annual interest between loan with different compounding. Okay, so compounding terms in terms of daily, monthly, annually, and etc. The formula for effective rate of interest is interest over principal times 1 over time. Interest over principal times 1 over time. Okay, for example, company XYZ intends to borrow 2,000 for 90 days. On maturity date, company XYZ pay 2,000 plus interest of 60. Calculate effective rate of interest. So you take out the formula, interest over principal times 1 over time. Okay, interest over principal times 1 over time. So interest will be 60. 60 over principal is 2,000. Okay, 60 over 2,000 times 1 over time. So time you have to take 90 over 360 D. Okay, so 1 over 90 over 360. So the answer will be 12%, the effective rate of interest. Don't make careless mistake where time you should divide by 360. Jangan lupa Okay. Next, business credit. Okay, business credit exists when firm make a purchase. Usually, business credit offer involve a cash discount for early payment. Okay. Contoh apa? A supplier may offer credit terms of 2 over 10, net 45. So basically, this is a 2% discount offered for payment within 10 days. So this is actually the credit terms where 2 is the discount and 10 is this. If you pay within 10 days, you will get a discount of 2% or full payment within 45 days. So effective rate of interest, interest over principal time 1 over time. So interest is 2% over principal, principal 1 minus the interest rate. Interest is 0.02 times 1 over time. Time is 45 days minus 10 within 10 days over 360. So you will get 20.99%. Okay, other form of short-term financing. We have other form of short-term financing such as bank overdraft. Okay, what is bank overdraft? Standby cash flow to cover a firm daily working capital requirement. And then it is provided by bank. Firm can withdraw funds from the current account in excess of the credit balance up to the approved limit set up by the bank. So basically the firm already have current account for the business purpose. So the firm can withdraw the fund from the current account in excess of the credit balance. Let's say the credit balance is 100. So firm can withdraw more than 100 of the balance up to the approved limit set by the bank. Okay, other form of short-term financing apa lagi? Trust receipt. Okay, trust receipt used by a firm, also known as a buyer, to finance local purchase and importation of goods. So document executed by customer, pledger of goods or documents of titles. Good released to the firm by the bank so that the firm may sell the goods and pay the proceeds from the sale to the bank. That is the trust receipt. And upon receipt of the trust receipt document, the bank will lend the firm funds to pay the trade creditors or supplier for good purchase. Then banker acceptance. Okay, it is an issuance bill of exchange drawn by a firm to its order and accepted by the bank and payable on a specified date. Another form of short-term financing that allow firm to take delivery of goods from supplier faster to meet market demands. Okay, banker acceptance is another form of short-term financing that allow firm to take delivery of goods from the supplier faster to meet market demand. In the case of firm that is a seller or exporter, okay, it can arrange for BA for its customer, so it can have access to immediate fund for working capital. So the firm should have the access fund for working capital to maintain its operation. Next, letter of credit. Okay, letter of credit undertaken by the bank, acting in accordance with instruction of the borrower to pay stipulated amount of money stated in the letter of credit to a named beneficiary against presentation of stipulated documents and in full compliance of terms and conditions of the credit. So the letter of credit is acting in accordance with the borrower instruction to pay stipulated amount, right? And LC also issued by bank to the supplier act as a form of guarantee payment. The supplier will be able to collect the payment when all conditions of the letter of credit are met. Okay, type of letter of credit include irrevocable LC, where such letter of credit cannot be amended and not cancelled without agreement of all parties. And standby LC. Standby LC where funded only if the buyer does not pay the seller as agreed upon. And revolving LC where used for regular shipment of the same commodity to the same importer. Means that credit facility is set up within LC balance drawn down against the credit facility balance. Okay, that's all for short-term financing. So basically, in a short-term financing, you have to understand the cost of credit, how to calculate the cost of credit, and then unsecured funding and secured funding, advantage of short-term financing in terms of borrowing flexibility, ongoing funding, easily available, okay, no specific agreement, lower interest rate, as well as greater credit amount. But short-term financing also have weakness, such as higher cost for account receivable, liquidity asset are used as collateral, right? Very simple topic. Okay, that's all for today. Thank you.